Right now, while you're listening to this, something is quietly happening to your money. If you think inflation is random, by the end of this video you'll realize it's engineered. You go to work. You earn your paycheck. You deposit it into your bank account. And without you touching it, without you spending it, without you making a single mistake, it's losing power. Not because you're bad with money, not because you skipped investing, not because you bought coffee this morning, but because the system is designed in a way most people never see. Let me ask you something. If you had $10,000 sitting in your savings account 3 years ago, does it buy the same life today? Same groceries? Same rent? Same home price? Of course not. And here's the uncomfortable truth. That difference didn't just happen. It was engineered. Today, we're uncovering one of the most powerful economic forces ever identified, a mechanism that has been quietly widening the wealth gap for centuries. Once you understand it, you'll never look at money the same way again. And more importantly, you'll know exactly how to position yourself so you're no longer the one losing. What they don't teach you about inflation. Most people think inflation is random. Like weather. Something that just happens. Prices go up. Things get expensive. We complain. Life moves on. But inflation is not random. It has a pattern. It has an order. And that order determines who gets richer and who falls behind. Imagine this. The government decides the economy needs stimulus. The central bank creates new money, not physically printed bills like in old movies, but digital dollars created with a few keystrokes. Trillions of them. Now here's the critical question. Does that money appear equally in every American's bank account? No. It never has. And that difference, that order, is everything. The 18th century discovery that explains modern wealth gaps. In the 1700s, an economist observed something most people never even considered. When new money enters an economy, who touches it first? This insight became what we now call the Cantillon Effect. And it explains nearly every modern financial boom and bust. It explains why after major crises, asset prices skyrocket. It explains why billionaires multiply during economic recovery. It explains why middle-class wages barely move while the stock market breaks record after record. The principle is simple. The people closest to the creation of money benefit first. Everyone else adjusts later, after prices have already risen. And that delay is where the wealth transfer happens. How new money actually flows. Let's walk through a real-world example. The central bank expands the money supply. That new money doesn't go to teachers. It doesn't go to construction workers. It doesn't go to small business employees first. It flows into large financial institutions. Major banks. Investment firms. Corporate lending systems. At that moment, and this is critical, prices haven't adjusted yet. A $300,000 house still costs $300,000. A company's stock is still trading at yesterday's price. But the institutions now holding new liquidity know something. They know more money is entering the system. They know demand will rise. They know asset prices will respond. So what do? They buy. They acquire real estate. They buy equities. They fund private investments. They leverage credit to control more assets. They move before prices rise. And when the ripple spreads outward, asset prices surge. Homes climb. Stocks climb. Private equity valuations climb. By the time the broader public sees the inflation numbers, the gains have already been captured. Why asset owners win first? Here's where the divide becomes visible. If you own assets, stocks, businesses, rental property, inflation often increases your net worth. Because asset prices tend to rise when money supply expands. But if you trade time for money, if you rely purely on wages, your income adjusts slowly, sometimes not at all. Meanwhile, rent increases, food costs increase, insurance premiums increase, Home prices move further out of reach. You feel squeezed. Not because you're lazy. Not because you lack discipline. But because you were last in line. This is not an emotional statement. It's a structural one. The evidence over the last 2 decades. Look at the last 15 years. The money supply expanded dramatically after financial crises and global emergencies. During that same period, stock markets hit historic highs. Real estate valuations exploded. Corporate buybacks reached record levels. At the same time, real wage growth for average workers remained relatively flat. The cost of living accelerated. The gap between asset owners and wage earners widened. If money expansion were evenly distributed, we would expect proportional gains across income levels. But that's not what happened. The majority of wealth appreciation occurred in asset classes, which means those who owned them benefited first. That's the mechanism. That's the pattern. Why the rich feel inflation later. Here's something most people miss. Wealthy individuals don't experience inflation the same way. If grocery prices rise 15%, that doesn't change their lifestyle. If housing prices surge, their properties often appreciate. If stock markets rally, their portfolios grow. Their assets adjust upward. But someone with savings sitting in cash? Their purchasing power erodes. And here's the quiet irony. Holding cash feels safe. But over long periods, uninvested cash loses ground. It doesn't collapse dramatically. It just fades. Quietly. Year after year. Why this effect is stronger today? In the past, monetary expansion moved slowly. Today, money can be created digitally in massive amounts within days. Financial markets react instantly. Information spreads globally in seconds. That speed magnifies the effect. Asset prices respond faster than wage negotiations ever could. So if you're waiting for your paycheck to catch up, you're racing against a system designed to move quicker than you. The difference between income and wealth. This is where most people misunderstand financial success. High income is not the same as wealth. You can earn 6 figures and still fall behind if you hold most of your money in cash. You don't own appreciating assets. You increase lifestyle costs with every raise. Wealth is ownership. Ownership of businesses. Ownership of productive assets. Ownership of things that respond positively when currency weakens. If the money supply expands and you own nothing that appreciates, you absorb the cost. If you own assets, you participate in the upside. That's the shift. The invisible wealth transfer. Every time new money enters the system, it redistributes value. Not through legislation. Not through headlines. But through timing. First receivers gain purchasing power before prices adjust. Late receivers face higher prices with unchanged income. That difference compounds over years. It's not one dramatic event. It's steady, gradual, relentless. And if you don't understand it, you'll misdiagnose the problem. You'll blame budgeting. You'll blame coffee. You'll blame yourself. When the issue is structural positioning. So what can you do? Panic doesn't help. Complaining doesn't help. Waiting for reform doesn't help. Understanding helps. The question isn't how to stop the system. The question is how to position yourself within it. Step 1. Prioritize asset ownership. Even small amounts. Broad market index funds. Retirement accounts with equity exposure. Business equity. Productive investments. Step 2. Minimize long-term idle cash beyond emergency needs. Step 3. Increase skills that allow surplus income to be deployed into assets. Step 4. Think long-term. Because the mechanism operates long-term. The earlier you participate in asset ownership, the more you shift from being affected by expansion to benefiting from it. The strategic mindset shift. Stop thinking only like a worker. Start thinking like an allocator of capital. Even if your capital is small, every dollar has a job. Either it sits passively losing strength, or it works inside systems that adjust with inflation. This is not about chasing trends. It's about understanding monetary flow. It's about recognizing that money created flows somewhere. The key question is whether you're positioned upstream or downstream. The real financial education. Schools teach budgeting. They rarely teach monetary mechanics. They teach saving. They rarely teach asset acquisition timing. They teach career growth. They rarely teach system positioning. That's what we build here. Understanding how capital moves. Understanding incentives. Understanding structure. Because once you see the architecture, you stop playing blind. Your choice moving forward. Now you know. Money creation isn't neutral. It has direction. It has sequence. And it has consequences. You can ignore that and hope wages outrun expansion. Or you can participate in ownership. Not recklessly. Not emotionally. But intentionally. Every decade will likely include monetary expansion. Every expansion will affect asset prices. The only question is, are you positioned to absorb inflation? Or to harness it? The bottom line. The system rewards proximity to asset ownership. It penalizes long-term passive cash holders. It amplifies gains for early capital participants. It squeezes late wage earners. Understanding this doesn't make you cynical. It makes you strategic. And strategy compounds. If this opened your eyes even slightly, if you see money differently than you did 20 minutes ago, then you're already ahead of where you were. Because awareness precedes action. And action precedes wealth. If you want to master the deeper mechanics of money, investing psychology, and wealth building strategy in America, make sure you're subscribed to Freedom Fund Mastery. Every week we break down the principles the financially literate use to stay ahead. No hype. No shortcuts. Just systems. Because financial freedom isn't accidental. It's engineered. And now, you know how the engine works. I'll see you in the next one.